Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. Before we jump into our next episode, we have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.DealCatalyst's.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review. We encourage your feedback. It'll help us make these episodes a better listen for you. And now, on to our next episode. A special episode of the Credit Clubhouse today. Deal Catalyst, we just released an ABF survey. And so I'm joined by Ganesh Rajendra, Rory Mempham, Julian Schickel, and we're going to be talking about the ABF survey. So now I'm going to turn it over to Ganesh and our speakers. Ganesh, please take it away and enjoy this episode, everyone.
Thank you, Todd. Just by a quick way of reintroduction, my name is Ganesh Rajendra. I'm a partner at Integer Advisors, which is a boutique private ABF advisory business. I also have the pleasure of being the non-executive chairman of DealCatalyst's. So I'm hosting this in the capacity of both that as well as my subject matter expertise. Very pleased to have with me both Julian and Rory, and I will ask them to introduce themselves before we get going. Rory.
Thank you. So I'm Rory Mepham. I'm the CEO of the Sancus Group, which is a alternative lender in the real estate forum, and we're active in the UK and Ireland. And we have assets under management of circa £300 million.
I'm Julian Schickel, co-founder and managing partner of Evelinia Capital. We're focused on asset-based financing, mostly in the lower mid-market, to what we call the innovation economy. So really think scalable originators and specialty finance businesses, where we work across the capital structure in ticket size between 5 and 50 million. Roughly speaking, with a focus geographically on the UK and continental Europe, but venturing beyond that as well, looking actively at opportunities. Ganesh, Todd, I think Todd has already left, but thank you so much for having me. And Rory, looking forward to a good session here.
Yeah.
Thank you, gentlemen. So let me just kind of give the background picture to this particular survey. So this is DealCatalyst's, really the inaugural survey of a market that they're massively dedicated to as a business, both on the events as well as now increasingly on the intelligence side. So the survey was conducted hot off the heels of their two recent flagship ABF conferences, both in New York and in London. The survey covered 128 responses across the three key constituencies that kind of make up the flow of capital within this particular private market. Namely LPs, so pension funds, insurance capital, endowments, and so on. GPs, which is a loose term used to describe asset managers, whether that's alternative funds or real money funds or hedge funds, as well as borrowers, which are the specialty finance platforms that lend within this ecosystem. In terms of jurisdiction, the respondents were split roughly equally between the US and Europe, with a small trail of other respondents. We can't statistically opine on the kind of sampling relevance here, but rest assured, we think that this poll, provides very valuable insights into the allocation, the investing, as well as the borrowing trends within this market going forward. So with that, let me hit the high level kind of findings and get a sense from you guys in terms of what you think. I think one of the more notable themes that came out of the survey, and not surprising, but still, was that the LP allocation intentions in this space continued pretty firmly to point to a bias for kind of the larger, maybe the more blue chip firms. So, and I know this has been a big never-ending bugbear for mid-tier to more boutique asset managers. Their capital keeps flowing to the large players rather than being more socialized. By the way, the overall LP response clearly also points to pretty much a bull market in ABF. But going back to this bias, maybe start with Julian. But how does that, as a more kind of specialist or niche player within ABF, do you feel this selective nature of LP allocations, and how do you deal with it? How do you adapt your business model to manage that?
Yeah, maybe if I start sort of a little bit before that, what really struck me is how unanimous the directional message is. You know, when we started out a few years ago, at least in continental Europe, people did not understand where we were coming from, what we wanted, and what we were doing. So it was really some obscure niche that people, hadn't really thought about as an asset allocation, certainly, even though asset-based lending is really, if you think about it, the oldest form of credit. You know, in Mesopotamia, people were already lending against future crop harvest, right? So obviously, this is not a new thing. Banks have been playing in this space for a long time as well. Now, fast forward to now, or the last 2 years, suddenly every second, if not every private credit conference headlines some big ABF panels, and everybody's talking about it. Now, from our perspective and the numbers we see, allocations have certainly increased. You know, in the UK, increasingly so also in Europe, but I think there's still a lot of talk and a bit less action, at least in what we really see. Sort of if you look at Europe going down from north to south, that's kind of where the trend is. Now, having said this, people are interested to have the discussions. We actually have continental European investors. It has ABF as a theme has clearly arrived in the mainstream, and that is creating opportunities for large and small managers. Now, to dissect your question a little bit here, I think, and obviously the findings of the survey, it's not a surprise that the focus is on large GPs when something is perceived new. There is some level of perceived risk as well. And clearly, starting with career risk, you typically don't get fired if you allocate money to Blackstone. You may get fired if you allocate money to some small obscure manager that nobody has ever heard about and it goes wrong, right? So that is obviously a starting point, and I don't want to make that here the sole reason, of course. I think what is more important is there is a general focus on ABF. There are opportunities in the lower mid-market as well as in the larger market. Yes, some LPs, the majority of LPs, may prefer what can be referred to as blue chip managers. Having said this, the opportunity set in ABF is often actually in the smaller ticket sizes, in the smaller opportunities. We sometimes see spreads or absolute yields of up to twice what we see in larger established transactions. So obviously, large GPs have an advantage when it comes to bandwidth in terms of capacity of doing due diligence, or at least that's the view LPs may have. If you really look through the organizations, what you often find are 5 to 10 people teams that do also other things. Whereas in a shop like ours, and I presume Rory's, don't want to put words in your mouth, this is all we do. So I think there's a huge opportunity to differentiate ourselves by doing that bit of extra work, going deeper in the due diligence, being in front of the data, working with the originators and specialty lenders to get that clean data and actually make sense of it. Sorry for long.
So I think you're right, and I think the whole safe pair of hands approach, rather than selecting the best risk return opportunity in terms of GPs, is something that we see across all strategies, right? It's not specific to ABF or private credit, but across the market. So thank you for that. And I guess an interesting ancillary question here, and to you, Rory, is as a borrower in this space, has the market matured to the point that you are speaking directly to LPs, pension funds or endowments or sovereign wealth funds or insurance capital, or is your interface still largely asset managers?
The answer to that simply is yes. Our interface is still with managers, and it's necessary for us. I mean, being the borrower, to Julian's point, we're in the weeds, doing a ton of work, originating opportunity, underwriting in quite granular, asset class that we're in. And frankly, our take from the money that we're lending on to a borrower that they're paying us a rate, we get a relatively thin take
Right.
on the overall economics. And, one of the reasons for that is because, we have to give, a pretty large take to the manager sitting in the middle who has aggregated the capital from all the LPs. And, that deserves a premium and so on and so forth. But yeah, we've seen no evidence of LPs willing to do business directly with borrowers such as ours. At the recent conference, met a number of, I think, sources of capital that would be relatively new to
Hmm.
the opportunity that exists in Europe. And we're going to do a bunch of follow-up meetings and so on and so forth. But whether any of those groups are willing to build a business and, sort of ground up, if you will, invest with a group such as ours, I'm not sure. Or whether they, come in and make an allocation to a fund that's being raised by someone else. And I think that's probably more likely. But
Yeah. Thank you for that. One of the interesting survey responses was that borrowers showed a significant interest in engaging with the banks, which is interesting insofar as, over the past 15 years, banks been largely outside of this market. But now, it seems like principal finance desks are becoming a lot more active in providing senior financing. And that leads to the second question, actually, we have. That is, so the borrowers surveyed showed a very ambitious financing requirement. Half of those surveyed, and sampling bias aside, half of those surveyed are in the market for financing or capital of 250 million and greater, whereas the asset managers surveyed, half of them were planning to deploy less than 50 million. Now, am I making too much of this as in this is simply a case of being solved for in terms of bank leverage? Or is there a mismatch here? Either one of you, I mean, from your own perspective, in terms of investing and borrowing.
I can
Maybe.
definitely just take the first part of that, maybe, Julian. We've seen a lot of interest from banks, definitely. Investment banks, challenger banks in providing facilities. The difficulty is that, they all require, fairly significant participations from their borrowers.
Mm-hmm.
And our challenge is on how to fund that participation, because if we're looking to grow our business, we've currently got 300 million of AUM. 5 years time, I'd like to be well north of a billion. That would require, if we could leverage that 70-80%, it's going to require a couple of 100 million of participation capital. And that is the piece which I feel is more challenging, because a lot of the people who are willing to participate in that piece, they want to start by writing a pretty big check. And it's not so easy to build a business that's ready for that type of capital. We'd like to find people who are more willing to kind of grow with us.
Yeah, and just out of interest, the conversations that you're having with these investment banks and challenger banks, is there appetite to provide full whole loan financing and not have an institutional mezz or residual provider?
We don't see much of that. There are probably some specialist lenders who will have that possibility, but more often than not, we are approached by banks who are looking for that additional mezzanine capital. In many cases, banks approach us and other smaller managers, I'm sure, about opportunities that are still too small for them, but where they would like to keep a foot in the door for if and when that has scaled to a level where they can play a role, and be that as direct senior financer or be that to provide back leverage. I think, if you think about most ABF deals are structured around warehouse financing, warehouse structures, or forward flow. the ticket size on day one very rarely matches the total intended program size. Also, there is a trend of inflation of these numbers, and almost every originator we speak to has a higher number in mind and very ambitious, growth plans. These are typically growth companies, right? So they, by the nature of that, they are often aggressive in their forecasts. So I think it is about finding the right structure and, importantly, leverage. When we talk about banks then coming in as senior leverage, may solve for quantum, but not for underwriting, right? It amplifies what's already there. So really the job starts often with a smaller pool where people like us come in, do the underwriting, do the deep dive, the due diligence, and then typically, and again, there are some exceptions, but typically bring in a bank slightly later. But, if you think about it, a GP writing a, say, 30 million check as a senior or stretched senior facility may still be able to support a 300 million annual origination, depending
Right.
on how quickly that turns, what recycling terms are, and then again, what leverage you add to that, either day one or later, typically later on.
Yeah, no, I agree. Great. Okay. One of the other notable outcomes from the survey was that it pointed to a very broad-based asset class appetite among asset managers, GPs. No obvious preference for any one single asset type, no obvious preference or limitations to invest only in kind of platforms with big, long track records, and so on and so forth. Is this, I guess the first question is this just a natural reflection of the bull market that we're in right now, the ABF market? Feels like investments are being driven by the need to deploy rather than asset selection per se. Or is that a harsh observation? And Rory, from your perspective, as a borrower, do you see this waterfront of capital, or is it? Do you feel that it's that particular survey response overstates the kind of how flush the system is with capital? Let me start with Julian actually on the deployment and the appetite in the space. Is it really? Is everyone really asset agnostic and structure agnostic and borrower agnostic as long as they can deploy?
I think we have to differentiate here between borrowers, GPs and LPs, right?
Right.
So yes, there's demand for everything, and it's essentially, I think on the investor side, a lot of investors are still, when they think about asset-based finance, they think about hard assets. In some other cases, they may be thinking about financial assets and shorter duration, self-liquidating exposures, which is a very different animal. Ultimately, the way we approach it is, in theory, as long as there are contractual cash flows, we can lend against it. If we can determine those contractual cash flows, if we can model them and get certainty and confidence on that. But what it does require, with that broad appetite from borrowers, is due diligence that is deeper than ever. We need to be able to control, stress test, and model these exposures no matter what they are. Again, I think on the LP side or the investor side, appetite is probably more specific, or maybe graduates over time. People start with something they understand, they're more used to, and then see that there are other financing opportunities in ABF, if you take it as a broader array as well. We really, as a, sitting at the smaller, more innovative end, we work with early stage and growth companies, and we clearly explore sectors that go beyond the traditional toolkit and assets that are there. But ultimately, it's a question of supply and demand. You need to be paid for the risk you're taking. From our perspective, the market is maturing, and that is clearly witnessed also by that appetite that we're seeing, not only in the borrower, but also on the investor side. But this is not 2007. The appetite is broad, but again, at this point, we don't see too much excess. There are maybe some signs right and left, but it has not reached our niche of the market too much. I would say
we're not yet in a bubble is another way of saying it, I guess.
I would say the bullishness is at this point largely tempered by discipline. Now, obviously, we've seen some recent news flow that contradicts this. Interestingly, specifically in large bank-style ABF facilities, where often a syndicate of large banks underwrote what they probably shouldn't have underwritten. And I think there are, we did a bit of an analysis on that. And of course, we all make mistakes and things can happen, and fraud is one of the big risks in this market. But I think it's important to note that in many of these fraud or quasi close to fraud cases, a simple Google search would have already avoided investment in these so-called opportunities.
Yes, yes. Rory, what do you think from your lens as a specialty?
Yeah, I mean, I think there is a deep pool of capital interested in the sector, and a lot of whom have very ambitious plans about deployment, and that is, but and I've seen this before in other cycles, in other asset classes. You've got a wall of capital trying to deploy, and they're looking for the sort of unicorn of, I want to deploy 500 million, in the next 3 months, and if you can't help me with that, then I'm sorry, but there's no point in continuing the conversation.
Right.
And the
It sounds like a luxury problem to have, but it probably is not.
Yeah, I mean, so they meet an ambitious borrower, for example, as we are, and we're saying we can help you deploy 500 million, but it's going to take 2 years, 3 years, not the next 3 months, and so move on. And I question then whether based on the fact that there seem to be quite a few people looking at the market capable of deploying those kinds of numbers, whether they are all able to get a piece of the market, or whether they end up, not being able to find anything because they're looking for the sort of holy grail of a nice book that they can invest into today,
Yeah.
and not be involved in the sort of building up to get to that level. Particularly, my observation would be on, for instance, US businesses that have built, quite significant size platforms in the US, beginning to explore Europe and sort of saying, well, how could we come into Europe? It would be interesting for us if we could get 1 billion to work quite quickly. But it's a very fragmented market in the UK and Europe. It's not so easy to get those sort of volumes deployed.
Exactly.
Yeah.
And ABF is still substantially a US
Yeah.
asset class, and I guess in Europe we're still playing catch up. But actually, one of the other noteworthy survey outcomes was that Europe and the UK, and again, I'm going to caveat the sample bias aside. Europe and the UK had a disproportionate kind of footprint, if you will, in people's investing intentions, whether it's LPs or GPs, asset managers. Now we're all European based, so we start from that point. In that perspective, are you talking more to US non-European investors as part of your capital raising strategy and the exercise in itself? Julian, in your case, to LPs, and Rory, in your case, to GPs and other investors?
Maybe if I start that off, I would say, looking back at almost 25 years in my case in credit markets, it's probably, in my perception, the moment with most US interest I've ever seen. US investors have always looked at Europe, and of course there were episodes where there was a distressed opportunity in certain markets, and that was a different story. But as an overall performing credit allocation, Europe has hardly ever been really interesting for US investors. It's always been on the monitoring list, and they've looked at it and were curious, but really the opportunity at home was good enough, and there was no real need in US investors' perception to diversify too much. I think that has changed. For the first time, we are really seeing US interest more than just curiosity, but actual allocations. On our side, we are starting to have initial discussions. We're going into fundraise again, so it's early days. But anecdotally, I was recently in New York. There's definitely interest, and it's serious interest. I think from a risk return perspective, yes, Europe is playing catch up, but Europe is still attractive, or is attractive compared to the US. You also have, for once, you don't have a negative carry as a US investor if you hedge your European investments. So that certainly helps to a degree as well, despite the, well, obviously to be seen in line with the, in conjunction with the rates differential.
So sorry, let me just stop you there. So the US money that you're talking to wants hedged exposure.
Mostly, yes. And if they do it on their end, or if we do it for them, I think that's a different different cup of tea, and the
Okay.
question, largely organizational size and what they want to do. I think Europe remains inefficiency rich. We have these fragmented markets with different typically different laws, different enforcement regimes, different regulation. That's hard to navigate without the right partners. But I think what differentiates us and some other managers in the market in Europe is that we can navigate those markets and have experience doing that and can unlock some of that opportunity. We've seen a few US managers opening London offices, less so continental European offices. I think that's often, there are exceptions, but it's often a harder thing to really establish and be successful with than is initially thought, because you still need to navigate, all these small countries with all of their quirks. And to the earlier point, deploying $1 billion is very hard. The $1 billion will look like, 100 million from here, 150 million from there, 50 million from there, and et cetera, in completely different legal systems.
Of course. And Rory, are you in your conversations with investors, are you speaking more to non-European investors?
Yeah, and that, it's early days, but I've seen evidence. Absolutely agree with Julian. There are sources of capital from the US that we have spoken to recently, who turned off their interest to Europe a couple of years ago, but are back, if you will. And I think there are also new entrants or people who've built pretty meaningful sized programs in the US and are looking to see if they can develop a similar model in Europe. And like Julian, we would hope to be a conduit for that.
Okay, and just dig into slightly finer detail. We've been using the term Europe. If you were going to distinguish UK and continental Europe, are we talking about UK substantially, or are we talking about continental Europe?
For our business, certainly the UK and Ireland is where we're at today. I mean, in the fullness of time, possibly other markets, but I'm talking about the UK and Ireland.
Sure.
For us, it's a combination. Historically, we've roughly our portfolio has looked like roughly 50% UK, 50% continental Europe, with 5 or 10% up or down at times over time. And I think that's a function of, specifically in our niche, the UK. Often we see developments in the US that then first come over to the UK and then trickle over and trickle down north to south in Europe. And that's the same, especially when it comes to a lot of the more novel ways of lending, some of which we finance. A lot of digital driven or fintech lending models, digital asset origination. There is just a much larger, substantially larger and more developed space in the UK at this point. And Europe, that is playing catch up.
And do you feel that there are other jurisdictions, non-US jurisdictions away from Europe, such as the GCC, the Gulf, Australia, and so on, that's competition for the money, for ABF money?
I think it's actually very interesting, and we're looking at it actively. We haven't done anything yet, but the GCC specifically, but also some other regions even further afield, there's a lot of opportunity emerging, and relatively rapidly. We actually see a lot of GPs going in there quite early to figure out this opportunity. We don't necessarily want to or need to be a first mover there. Hopefully you can learn something from initial experiences others are making, but it's amazing to see how quickly the opportunity set is developing, and how, in the case of Saudi, in the case of the UAE, for example, this is also very much sponsored by government entities or ultimately part of the plan. And it's great to see how quickly that's developing. We've recently seen some very interesting transactions, and I would hope that sooner rather than later, we're already spending some time there, but we'll be active in that region as well. Yeah,
great. And I guess the last question before I open it up to other questions you may have, but Rory, in the UK, I guess development finance bridging space, which has been super active, I'd say, in the last few years, do you feel there's an imbalance between the supply of capital and the demand for capital, or do you feel that it's pretty well matched? Is it a market for borrowers, or is it more a market for investors?
I think it's a good question. I think there's a small number of active GPs and asset managers in this space. There's a big market of borrowers, but I would say of that large pool of potential borrowers, I think that GPs, asset managers ought to be very selective on who they choose to do business with, because it is quite a young industry. A lot of the businesses are quite young. Even some of the people in the businesses are quite young, and the advantage of partnering with businesses where management have got some grey hair, have or no hair, and have experience and track record is quite significant, because working your way through a difficult cycle, working your way out of problematic loans, knowing that the grass isn't always greener on the other side is super, super important. And there's quite a lot of people who've been pretty active in our space in the last 5 years haven't ever really seen what can go wrong. And so I think there's quite a bit of money looking at the market. There could be more. There could be more variety in the number of GPs looking to deploy. But I'm not so sure how many really good quality borrowers there are out there. So probably the answer to your question is it's about balance at the moment. But from a borrower's perspective, we'd love to see some more GPs and investment managers to do business with.
Sure. And Julian, last question for you. In your lens into the LP universe that have appetite for ABF, dedicated ABF strategies, is it heavily US weighted, or do you speak to LPs in other parts of the world that may have an interest in ABF?
You mean on the investor on the LP side? It's quite mixed, I would say. As I said earlier, I think Europe has been waking up. So first you have the direct lending boom, starting, I don't know, 15 years ago or so. And in fact, when I was still working for a hedge fund or alternative credit manager, we witnessed the advent of that, and our thesis was we'll see the same in what I call portfolio credit, i.e. ABF, right? Moving from public markets to private markets, and of course that's exactly what has happened. Sort of 10 years on, maybe a bit later than expected. In terms of appetite, I think what is true is whenever we speak to U.S. investors, we were initially baffled by how sophisticated they are. They know our space, they know our peers. You start with some lengthy explanations about what you do, and they cut you short and say, yeah, we know your space. We've invested with ABC, and we've met these two European managers already. That has been different in continental Europe. The UK is somewhere in between, I would say. Having said this, a market like the UK then being very driven by, on the institutional side, by consultants, for instance, on the pension side, that is its whole own animal, i.e. you need to get through that gatekeeper and get the gatekeeper's attention and get them comfortable before something meaningful happens. So in short, we see appetite from the US, and as we discussed earlier, increasingly so also for Europe, which is great. The US is ahead in terms of ABF allocations and sophistication. At the same time, I think European investors in many countries and segments are now ready to diversify away their private credit exposures from direct lending with some large managers and 15 loans across 3 portfolios to something that's extremely granular, less cyclical, bears other risks, but certainly diversifies the private credit exposure.
Right. Yes, I think reading the survey, listening to both of you, I think feels like we're on the cusp of something bigger for ABF now that the strategy is so much better defined. Definitely looking forward to that. But anyway, gentlemen, thank you for your time and your insights. I think that's it's been very interesting discussion. And I wish you happy holidays and a happy new year ahead.
Happy holidays, happy new year. Thanks so much, Ganesh and team.
Thank you.
Bye-bye.
Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. We have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.DealCatalyst's.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review.